Well, good deal. Well, look, we'll get started. I know some of you have taken a trip to meet in person and sit with Vicky, and some of you guys have received the invitation or attending maybe online at your desktop. But first off, I want to thank everybody for taking a few minutes today to hear a little bit about this exciting new program. I'm joined by a couple of guys who I will introduce here shortly, but just kind of quickly, let's see, just an agenda, short and sweet. So we want this to be really efficient, but really educational. And so we were excited about a few slides that we'll be sharing here shortly. But for those who haven't heard about this new program called the Opportunity Zone program, that's the primary thing we'll be discussing today. And so I've got some experts on the program with us, and really excited about some of this content. But just quickly, I'll introduce ourselves and talk a little bit about me and our firm at the Retail Coach, and then in our partnership with Manassas Capital. We'll talk a little bit about the Opportunity Zone and how it works. Then we'll talk specifically about Fort Dodge's Opportunity Zone for those who aren't aware. We got a few slides in here that I think will be really interesting for you guys to hear. And then lastly, I'll let Manassas talk a little bit about their team and their firm, and we'll just jump right in here. My name is Will Klein. I'm a project director here at the Retail Coach, and we recently signed on to work as a partner with Fort Dodge to help drive retail and restaurant development to town. And so working really closely with Vicky and Chad with the city, but we are really excited about this project. It is brand new. We're about 2 weeks or so into the partnership, and we had a call with Chad and Vicky this morning to talk a little further about the project, and it's one that we're really excited about. Also online here with me is John Lindsay and Mac Wilkie. These guys are with Manassas Capital, I believe located in Texas right now, but they're the Opportunity Zone experts, and I'll just ask them to say a quick hello.
Hi, everyone. This is John Lindsay, and I'm here with Mac Wilkie. Thank you so much for taking the time. We'll introduce our firm in a second when we get to it, but I just want to say thanks, and we'll try to be brief today and hopefully very informative for you guys and the market you live in.
Yeah, thanks, John. So a little about the Retail Coach. We're a firm that helps municipalities recruit retail and restaurants. So our job is to partner directly with the municipality or an economic development organization. And in this situation in Fort Dodge, we're partnered with the city of Fort Dodge to essentially act as their proactive retail recruitment arm. So we like to think of ourselves as sort of their in-house retail real estate team. And so our job is to study the market extensively, and then proactively reach out to restaurants, retailers, and developers, and put this market in front of those who are looking to expand sort of in Iowa and along in the Midwest. And so very early on in this partnership, I have identified already that this Opportunity Zone program is going to play a big role. And so we thought with Chad and Vicky and then John and Mac through a few conversations in weeks prior to today, that we thought it would be good for us to get together and sort of share with stakeholders in the community who may have an interest in this particular program. We just want to educate you guys on the program and so that you are equipped with the information that you need to maybe take advantage of it in whatever profession that you're in. And so with that, I think I'm going to try to turn it over to John and Mac to kind of jump into the meat of the program.
Thanks, Will. So like Will said, this is John Lindsay. I'm here with my partner, Mac Wilkie. So briefly on who we are and what our plan is, business plan moving forward as it relates to the Opportunity Zone program. So I personally am a lawyer by trade. I've spent the last 5 years in the investment banking world. Mac has spent his entire career in the investment banking world, both in real estate and operating businesses. The Opportunity Zone program has created a lot of buzz, especially in the real estate community, for a lot of valid reasons. there's a lot of misinformation with a lot of people trying to enter the market who don't really know everything about the program. They're just looking to get real estate deals done. But what you'll see is 99% of all the conversation about the Opportunity Zone program is focused towards areas of major metropolitan areas that, for whatever reason, were placed into Opportunity Zones. And we'll get into what those zones are and what they do and how to take advantage of them. But Mac and I, have a passion for, there's 8,800 zones. There are 8,750 zones that are not being really focused on by the articles in the New York Times and the people that are raising big funds. So we started Manassas Capital to go to the cities across the country that aren't drawing the attention from the major institutional investors and real estate developers who are focusing on the major metropolitan areas. So we're happy to be here, and we'll get going on the Opportunity Zone program and what it is. So very briefly, the Opportunity Zone program was a program that was put into the 2017 tax reform bill at the very last minute, literally in the middle of the night. It was a bipartisan legislation co-sponsored by Senator Scott, Republican from South Carolina, and Senator Booker from New Jersey. And the overarching theme, the idea, the purpose of the law is to get private capital invested into communities around the country that have not been, on the top of mind for private capital investment.
And really, that's the angle at which, our firm is focused, and we come to you, and why we're on the phone today. We've got a passion for seeing this program through as to what it was intended to be, and helping communities like Fort Dodge, take advantage of the program, access capital, and really put some things into place that, but for some of these incentives, might not have been feasible or certainly not as lucrative.
Yeah. So how this came about was after the law was passed, the Congress basically told each governor, here are certain census tracts, there are actual geographic locations that qualify for this program. You pick up to 60% of those tracts to designate as Opportunity Zones. These are actual areas of the country based on census tract that this program qualifies for. If you're outside of the census tract that's not designated Opportunity Zone, there's no way to take advantage of the program. So it's very geographically based. Fortunately for the Fort Dodge community, you guys have a Opportunity Zone in your city, and that's why we're here today. So go to the next slide, Will. There's three real elements of the program. So we just talked about the zones. One part about this program that is a little unique is that the money cannot go directly from investor to project. It has to go through an opportunity fund. That opportunity fund can invest in two things: operating companies or tangible property, which most importantly is going to be real estate. For that, the investors, which you'll see a slide breaking this down, get very significant tax incentives, sometimes tax shelters, for the investment of capital gains. So these funds, so it goes from investor to opportunity fund, and then the opportunity fund invest into either qualified businesses or real estate located in these opportunity zones.
So just to distill that down and kind of simplify it as much as possible, there are really three aspects. One, the zone, the geography, the census tract. We talked about that. There's a fairly substantial one in your community. So that box is kind of checked. Two is the term fund. And what that really means, they used it in the legislation as a means to try to encourage pooling of capital and the funneling of capital from, institutional investors into geographies that need it. In practice, a fund can be anything from, a single investor up to, a group of investors who have done deals in your community together in the past, to what you might think more traditionally of a fund as, a sponsor managing a blind pool of capital on behalf of investors that aren't in your community. And the last being the investments. Specific projects in the geographies that have been designated that are identified and fit kind of within the parameters of the tax incentives that the fund has laid out. So if you could flip to the next slide. Okay, we're there already, sorry. So the tax incentives offered really come in a form of fashion of three specific incentives. The first is a temporary deferral of capital gains. So any capital gain that you might have, whether it be through equities in the stock market, through an investment in a private business, through real estate that is appreciated over time, any capital gain is qualified for this program.
Whether or not that's located in a zone or not, obviously. So you could have a real estate project that's not in a zone, sell the building, you can invest your capital gains. Obviously, public stock is not going to be, located in the capital gains. So that's a little bit different than a 1031 or other things that has to be real estate.
So practically how it works, you sell an asset, you realize a capital gain, you have up to a 180-day window to invest that capital gain into an opportunity fund to be deployed. For doing that, you get a deferral of any capital gains tax that would have been owed on the sale of that asset for the lesser of 7 years or the end of 2026. 2026 was a somewhat arbitrary number. It has to do with when the tax budget gets rejiggered. So really those two dates, as we're sitting here talking today, line up a bit. To get the full 7-year deferral, you'd have to be invested by the end of calendar 2019. The second tax incentive offered is a step up in the basis on that gain realized today that is invested in the zone. So if you hold the investment for up to 5 years, you get a 10% step up in basis, and another 2 years, so 7 years total, you'd get up to a 15% step up in basis. Now, to us, this is probably the least powerful mechanism in the program. It's nice savings, but it's really, to be frank, dwarfed by the power of the 7-year deferral, i.e. allowing you to invest your entire gain rather than the tax affected 80% of that gain. And the last one we'll talk about, which is a permanent exclusion. So if you hold your investment in a qualified opportunity fund for up to 10 years, you can hold it through the 2040s, so a very long time, but at least up to 10 years, any gain on the investment in the fund is tax-free. So we'll get to it in a couple slides. We've laid out some numbers based on a handful of assumptions, but long story short, the exclusion on a capital gain event over 10 years can be very powerful in terms of driving return. Well, if you go to the next slide. So what makes opportunity zones so unique? Like we talked about earlier, it's an incentive that pertains exclusively to capital gains. But even more importantly, they've really opened the flexibility in terms of what capital gains we're talking about. Some of you on the phone might be familiar with a 1031 exchange that really only applies to real estate going into like real estate. This opportunity is, in our view, getting so much buzz because it opens up a massive pool of capital in this country for investment into this program. It's designed to concentrate capital rather than diffuse it. So by using the term fund and encouraging people to hold these investments for 10 years, we think that the program is properly aligned to incent people to take a really hard look at communities that they might not have previously. The program is designed to reward patient capital. We think that this is very important in terms of what it was designed to do, drive investment and economic development in communities that, but for the program, might have been overlooked. The way that the legislation is drafted, you're not going to have people churning in and out of funds These funds are going to be patient. They're going to be there for 10 years, ideally. So you're going to have the opportunity to really see the investment through, see the economic development that comes out of it, and really, we think, build communities in an effective and prudent way. It unlocks scarce equity capital. We've seen that there are billions and billions, if not trillions of dollars of capital gains tied up in the stock market right now. And, this is really the first program we've seen that's given a tax shelter for those gains. So allowing investors to take assets that have been in the stock market and they might be sitting in the stock market for years and years to come, but for this program, they can take those out in a tax-advantaged way, diversify their holdings, and invest into things that can really change communities. Really, this is a market-based program. That's another major difference. If you decide that you want to participate, it's a self-certification process. Certainly, there's a lot of compliance and things to do on the back end that we can talk to later. But on the front end, it's as simple as making the decision that you want to participate in the program, identifying an opportunity in a geography that fits, and making sure that that investment is flowed through an opportunity fund and structured properly. And last but certainly not least, that's why we're passionate about this program and why we're on the phone. It gives investors a stake in their own community. We have the view that, especially in the vast preponderance of communities that aren't on the front page of the Wall Street Journal or the New York Times, this is a program that's really going to be affinity-based investor-driven. So people who have a stake in their town, want to see their town develop, want to bring projects to bear in their town. We think this program is really uniquely positioned to do that.
Yeah, one more unique aspect that I would raise is the last point, there being no cap on the benefits. So there's really no guardrails here similar to another government program. The government truly made this program very clean and private market driven. So there's no cap on the amount of money. There's also no threshold. Someone with $25,000 of capital gains can take advantage of this program. There's no qualification that you need to be an accredited investor. Anyone with capital gains can truly take part of this program. And, someone with $25,000 or $200,000 or $1 million, is not priced out of seeing the investments in the local community get done. So some of those can be seen, some of the things Matt just discussed can be seen on this slide. I would focus towards the last, being simplicity. The complication arises when dealing with a fund level, but in terms of the actual investable projects, like I said before, this is truly a market-based program that the government thus far has not really put a lot of red tape around. So, you're truly only limited by the investability of the particular project. And we can move on past that slide. Well, so in terms of what an opportunity fund invests, so you as an investor or your clients as an investor or whomever's on the phone, once that money is into a fund, what can a fund invest in? So obviously real estate. Two qualifications there. The real estate obviously has to be located in a zone. So anything new located in the zone, piece of dirt, build a building, that works. No problems there. The second, if you buy an existing building, there's a qualification that the building has to be substantially improved. Remember, the idea behind this is to get jobs, to get buildings built, to get projects done in these communities. So what that means, what does it mean to be substantially improved? If you have an existing building, you have to have additions to basis equal to the original or basis in the building. So all intents and purposes, if there's $1 million asset purchase of an existing building and the land is worth $600,000 and the building's worth $400,000, over the next 31 months, that building has to be improved by a minimum of $400,000. With today's prices of redevelopment, that is not a huge hurdle. It originally, we thought when the first bill came out that you would have to spend $1 million, but they excluded the price of land from that calculation. So it's only the basis in the original purchase price of the building. So you can imagine different types. Downtown renovation is one that we're passionate about. And one thing on that line is any other tax credits are easily coupled with or twinned with this program. So historical tax redevelopment, Main Street redevelopment, those tax incentives from both the state and federal level are attributable to these projects. Now, this only applies whether it be businesses or real estate. The land must be acquired by the fund or by the entity that's developing the project post 2017. So one question we get a lot is, I've owned this land or this building for 25 years. What can I do with it? Right now, unless there's some changes, and there are pushes to do so from the Congress, there's a hearing going on as we speak in D.C. It has to be acquired post 2017 from an unrelated party. What does that mean? If you're a landowner, you can sell it to an opportunity fund that you have an interest in, but just not an interest above 20%. Businesses, any new business that operates in a opportunity fund, the corporate stock or partnership interest can be acquired by an opportunity fund. You can expand existing buildings and businesses. The only qualification, this is a real point of contention that we need Congress to clarify as it relates to businesses, is there is a stipulation that at least 50% of the income, the gross income that comes out of these businesses, be derived from active conduct within the zone. We're not sure what active conduct means. As a lawyer, the first time I read it, that's the first thing I circled was, what does active conduct mean? We're not sure. Congress is going to tell us, hopefully within the next 3 weeks. So hopefully we'll have an answer to that shortly. But I think that with the amount of push from people, that should be satisfied in a way that's beneficial to people growing businesses. Certainly if you have a coffee shop or a building that has a management team or any local business, a restaurant, anything like that, that's going to apply. There's no problem there. But if you have a business that's scalable, meaning having clients or services around the world, around the country, we need some clarification on that. And the last being infrastructure, and where we see this being very powerful, and in our conversations with Vicki and others in the city is things like public-private partnerships, partnerships that the city wants to do and might could raise a bond issue or pay for it some way and needs 20-30% of an income-producing project that needs private capital in order to fill it, close the gap in terms of getting that project done. In that, you have an asset, real estate or otherwise, that the city is behind, the government's behind, the state government's behind. That is a long-term tenant, a very investor-friendly tenant. Those could be very interesting to get infrastructure projects that produce income done in these zones.
Well, if you flip to the worker, great, we're there. So we talked about this earlier, and this slide, what it does is it puts numbers behind the tax incentives. And if you follow the numbers on the right, this isn't footnoted on the slide, but this assumes 10% annual appreciation. So you can see as it comes to the deferral of gains, in a traditional example, you sold stock, for example, that had $100 worth of gain, and you wanted to invest that gain into a building in an opportunity zone. Once you pay your 23.7% capital gains taxes, you're down to only 76.3 that goes into the fund. With the benefit of the deferral, your entire $100 gain can go in. So you're starting from a higher base, and obviously with compounded returns on that, it can become pretty powerful. The second kind of row down shows the difference in the step up in basis. As you can see from the numbers here, and we talked about it earlier, this is kind of the least powerful of the three, but with that 15% step up in basis, after year 7, you would only owe approximately $20 on your $100 gain, whereas if you paid them up front today, it would be that 23.7% or $23.7. And then we get to the last, which is the lack of any capital gains payable upon dissolution of the fund 10 years or further down the road. as you can see on the right, that's a very powerful savings. You couple those three together, $100 investment that grows at 10% a year, you're going to gain $140 when all is said and done after taxes. In an opportunity fund structure. In a traditional structure, you'd get up to 70. So essentially, it doubles your gain. And this is the incentive, the finance space that's getting people really excited. This, coupled with what we think it can do for communities in need, is really why we're at the table, and really why we think that this program's got a lot of legs.
So, what role, are we playing in communities? We only have, we're trying to keep this brief, so we're right up against the 30 minutes. We'll keep going, and Vicki, you tell us, when to stop, but we'll try to wrap up our end, and then, there's some slides about some projects that Vicki and others sent in about Fort Dodge specifically. So basically, just very high level, not getting too detailed on the slides. What we see around the country right now is communities that really don't know the first steps, how to do this, how to manage a fund, what a lot of cities, local governments, economic development officials are great at doing is identifying projects, promoting those projects, providing additional incentives to get those projects done, but aren't, not fund managers. So where we come in as kind of a dual role of consulting / fund management and helping, let's say, that the key players in the community, both in the government aspect or economic development aspect, as well as potential investors, developers, professional services, banking relationships, get in the same room and figure out what are the actual investable projects here that fall along with the city's long-term plan that are both that good for the community and good investments where people can make money through these tax incentives. Present to investors that may be outside your region, in a way that they're used to seeing family offices, private equity groups, seeing projects in the way they want to see them with the correct modeling in the format they want to see them. Identifying, community initiatives that these projects fall in line with, and as well as some publicly owned assets. Maybe the city owns some land, maybe some land that hasn't been used in quite some time that could be redeveloped, or businesses that could be started in some of these buildings that are up and coming. But really work with that group of key minds in the community to develop a plan. And then once, and this is kind of skipping towards the last slide, but wanted to get this out before we run out of time. And then, structuring a fund, whether it be, with the city or with the investors, or it can even be, a one-off project to start, but really helping, structure the fund and then manage all the compliance, the back office work that will be involved with compliance and taxes and accounting and things like that, as well as, finding new opportunities for the fund if assets need to be disposed of, prior to the 10 years and turned into another investment. Next slide. So this is, if you guys don't know, this is what we received from Vicki. This is the map of the area in which is applicable in Fort Dodge. Vicki, I don't know if you want to kind of highlight some of the potential projects and these are just used for example, I believe, but these are some of the possibilities that are located in the zone that Vicki identified early on.
Sure. So if you look on the left side of the screen by the river, we've identified just some of the green space that the city owns that would be available. We've also identified the old Fort Dodge Steel building, which is the number one, it's labeled number 1. Number 3 is that gorgeous building we're always trying to get from Steve Daniel that could be redone. Number 4 is the old hotel on First Avenue South and 3rd. And then 5 and 6 are some development areas around the new roundabout at 6th Street that would have potential. Number 7 highlights the Warden, Wakanza area and the intermodal hub. So that would be, I could see more of a public-private infrastructure project for the intermodal hub, and potentially the Warden could have some opportunity there. But really, any buildings downtown, there's multiple buildings with upper stories vacant that could be used for this project or this program.
Yeah. So, I mean, those are just some examples of some ideas that were at first glance, but it's really going to the direction of the Opportunity Zone program in Fort Dodge is really going to be directed by people who, have an affinity for the community. Most of you guys, I assume, live there, who want to get involved, not only for the tax savings, but to get projects done for the betterment of the community. Our role, like I said, would be to help advise and organize and manage those funds, along with, your professional services groups in town. This last slide kind of goes through what our business services plan is for communities like Fort Dodge. And you guys can review that as we're kind of running out of time, but, where we move from here is, obviously you guys all know Vicki and her office. I would say the next step, if there's enough interested parties to continue this conversation, would be, for Mac and I to come up there and sit down in a room for a full day with, both investors, any developers, property owners, professional services professionals, and talk about how we take this from actual projects to reality, and how that would look from a financial standpoint for the individual investors, and how that looks for the next 10 years. So we are excited about that possibility to come up and meet with everyone in person, if that's something that you guys want to do, and if there's enough possibility to get that done. We don't know enough about Fort Dodge sitting here today to make that determination for you guys. Obviously, during our conversations with Vicki, it appears to be that you guys have some interesting opportunities that are existing. There's opportunities, that maybe you guys haven't thought about, that we're working in other communities, and some ideas that we could share if we come up. So, I'm not sure how you want to handle that, Vicki. I'll leave it to you, and we can talk about it offline. But in the interest of time, you guys have our deck, and we can open up for questions, and we can stick around as long as you guys want to answer any questions you have at this time.
Yeah, I would like to take a few minutes for Q&A if you guys don't mind. One question I have, so there's talk about it, you have to be an accredited investor to be involved. Is that not true?
That's not true.
Okay, good. Because I just happened to see that recently and hadn't heard that before, so, okay.
Well, you know what, Vicki, that's the one, and we've been looking at this for over a year, and the amount of misinformation about this program is startling, even from some of the largest law firms in the world. It is startling, the amount of misinformation that's out there in articles around the world.
Okay. If anyone in the room here has questions, you can just go ahead and speak up. If you're at a site, you can, I think you can type in your questions in the chat box, and I can read them.
I got a question.
Okay.
Are you familiar with Skybridge Capital?
Yes, Scaramucci's fund?
They have 100,000 minimum, and you have to be an accredited investor to invest in their fund. And I think that's where you're getting at.
Yeah.
Yeah,
If we started
Skybridge is run by that Scaramucci guy that was worked in the Trump administration for like a couple weeks, and their background is a several $100 million, billion-dollar hedge fund, and that's just a parameter that they set based on their investor. That's not a requirement in the law itself.
Don't you think in the future there's going to be more hedge funds involved once they figure out the goodies of this program?
Absolutely. There's a lot of people out there hustling, you know, $500, $600 million real estate funds right now. I fully expect over the next year you'll see a great number of both anybody who's used to managing hundreds of millions of dollars. They will get into this because of the tax incentives and because the desire of you know, high net worth individuals, families, to place some of these capital gains. But that being said, I don't think they're going to look to places outside the top 10 metro areas in this country.
No question. Yeah. I get real jumpy with the government. Every time I deal with them, I end up in the bottom hole. Do you think they really finalized everything?
Well, they finalized the law. The law is, you know, the law of the land. There are some questions, you know, based like on the active conduct, the 50% gross revenue margin. There are some questions that need to be answered, and I guess anything is possible. They could decide to put more guardrails on it and make it more, you know, similar to a normal government program where you've got to show, you know, jobs, new jobs creation and stuff like that. But right now, it is very dissimilar from other programs. It was just truly a market-based program, and the government really doesn't have a whole lot to do with this program other than the ongoing compliance from a fund level. They don't really get to pick, you know, as long as the project's qualified, they don't get to tell you which ones you can do and which ones you don't. It's not like new markets credits where you have to apply to the state or the federal government to get money to do a project. You just do it, and then you know, designate on your tax return that you put that money into an opportunity fund, and with your accounting team, you get the automatic deferral.
Has the IRS signed off on it?
Yes, it's being run by the IRS and Treasury. Yes.
So they've signed off.
Correct.
Okay.
And there's really no need to wait. So there's some questions depending on what you want to do. But if somebody in the room, you know, had money and had a project and you wanted to start a fund and fund that project with it, you can do it today. Any other questions?
You talk about floors for both a fund and for a project to make this feasible, given all the overhead you're going to have.
We did not. Did you hear that question?
I'm just
We
wondering.
couldn't really hear, no.
What's the feasibility in regard to floors, both, let's say, for the size of the fund and the size of a project, to make it feasible given the administrative cost to monitor?
Floor for a project size. You know, really that depends on the, you know, amount of activity in and around. But this is a very flexible program, and the administrative cost really isn't that great from a project level. From a fund level, it would probably need to be in the neighborhood of a few to several $1 million to cover the cost. From a project level, due to the flexibility and scalability of projects that can be done and can qualify, I wouldn't think there's a floor.
And legally, there's no floor. There's no threshold in terms of dollar value in the law. It's just practically like Mac just said.
So a lot of discussion we've had here is, you know, does it make sense for us to set up our own zone fund? Or do we simply market projects that we have that could be invested in some other fund?
Well, that's, you know, it's really 6 one way, half dozen the other, right? I mean, you can do a fund for each particular project. We could come in and help you guys set up, if you had 5 projects, 5 different funds. We don't know enough about the projects, the potential investors, the developers to tell you that on this phone. But you could either do, you know, one Fort Dodge fund and market that in your community, or you could do, you know, separate projects. And and we would just have to sit down with you guys and figure out what the best angle is based on, many different factors.
And I think, Vicki, you were also asking about marketing to funds that are being established, maybe bigger ones that might be being established by traditional hedge funds, et cetera. And,
Right.
I think our view is it's very difficult to attract, that type of big capital into a community the size of Fort Dodge. And certainly having local buy-in, local investor money, the local stakeholders involved, we think only improves, the likelihood of success. So, is there outside capital available for some of the projects you might have? We think there very well may be, but it's going to take some wherewithal to both access that capital and present the projects and opportunities to them in a way in which they're used to digesting them, A, and then B, having local investors sponsor these projects is really going to be a key, and having some boots on the ground that can be there and oversee things. And in that case, you might as well have your local investors involved in their own fund as well to get the benefits.
What about privately owned companies that have investments or interest in our community? For example, the Koch brothers. We have a Koch plant as well as a Georgia Pacific plant, and maybe identifying what type of opportunity zone funds that they're investing in, saying, hey, this is a community in which you've already invested in, financially through industry type projects. Do you think that would be an angle?
Absolutely. I mean, the corporation.
The Cargill family?
Yeah, absolutely. And that takes, that right there would have to be, what exactly we're talking about. Come as a, unified front from the community and go to those, but they can certainly participate in the program for sure. Any corporation with capital gains applies, and that's a fantastic idea. And I mean, they can even be, I don't know if they're, it doesn't appear from the map that they would be located in the zones, but, any businesses that, want to expand in terms of real estate or numbers or equipment, that can all apply as well. That's a great idea.
I'm just thinking of one of our projects would be the Warden and the rec center that goes along with it, which is a workforce recruitment and retention piece, right? And if they have a large, employment here, that would be kind of go hand in hand with that goal, I would think.
Absolutely.
Yeah, and that's one of the things that we're working with other cities on is that may not be as far along as the Warden, but workforce development with the support of corporations around, as well as, some cities are taking buildings on the courthouse square. The economic development team is helping start a fund with us. They're gonna move their offices there and use the space from a ground level as, a workforce training, co-working space, startup incubator type deal that you see in bigger markets. And that's, serves a lot of interest in the community, both in terms of, getting people excited about going out and starting jobs. It gets the corporations because they're training their potential workforce to do the job better than they did before. And, there's no better economic development function than growing more businesses and increasing tax value and getting more people qualified to get jobs.
But I would dovetail on that, Vicki, and say that I think getting those stakeholders involved, maybe not personally, but more directly, is really a key here, because trying to back channel to them if they may be, invested in larger opportunity funds is always going to be challenging, because those opportunity funds have to deploy capital in a certain amount of time. And if you're talking about a $500 million fund, they're going to want to be doing $50 million projects at least, really, to try to deploy that capital in the time frame they have. So getting those stakeholders involved, maybe personally, through a city-sponsored fund or what have you, is really the key to controlling your own destiny on those projects.
Yeah. And following up on that, I mean, that's why we've, decided to go directly to the cities. I can promise you any of the, whether it's Skybridge or any of the other funds that are out there right now, they're not investing in any places in this country not named New York, San Francisco, Miami, Atlanta, Houston, Los Angeles. There's almost none that I know of, and I've seen most all of them, that are going, to the 98% of the zones around the country. So it's truly going to be up to the local community if you want to take advantage of this, if there's enough investment dollars, if the projects are good enough to underwrite, and obviously we help with that as well. It is kind of a call to the local community if you want to take advantage of this. There is, I think you're going to have to do a lot of it, take the initiative to some degree.
So what if I'm an investor? I put $1 million in this fund, and in 5 years I want to pull that $1 million out. How does that work without bankrupting the fund?
Well, I mean, that's the way you structure the fund, right? I mean, it depends on if that's a single asset vehicle, if there's other investors in. I mean, if you had your own fund and you want to do that, there'd certainly be no problem. You would get the tax benefit of the initial deferral and the first 10%, step up in basis. But if you're involved with other investors, it would need to be, pretty closed in terms of the hold period. You can't sell your interest to someone else and let them get the tax incentives. So, the investors would need to be contractually bound, to keep the money in for the duration, unless there was, you could obviously structure it any way you wanted to legally, if there was a minority vote to sell the asset and move on or take the money out or whatever.
Yeah, and there are fund structures that are very feasible that allow for periodic redemptions, and it could be upon the disposition of an asset. For example, in that case, you would just lose as an investor some of the tax incentives on the back end.
Hey guys, you there?
Yep.
Yeah,
Any other questions from any of the satellite sites? You can type in a question there on the chat box if you have any.
Yeah, I'm having a hard time. Hang on, I'm going to escape here to see if we had any questions come in. Yes, Sharon, this if you're still on, this PowerPoint will be available. We've recorded the entire thing, and we can also send over the slide deck. So really anything that you might need, we can get it over to you.
Yeah, and we're always available too. We'll make sure that Vicki has all our contact information, and like we said, this is something that we spend our day-to-day in, and we're passionate about. We're from small towns. We want to see small towns flourish, so we're happy to answer any questions and play a part as we need.
Any other questions in the room here?
Well, good deal. Look, I want to thank everybody for. I want to thank everyone for spending a few minutes with us. John, Mac, Vicki, I appreciate y'all's time and work on putting this all together. I think it was really successful, and for the questions and things that we get sort of after the show, we'll make sure to answer those in a timely manner. But again, thank you all for attending.
Thank you very much. Appreciate it.
Thanks, guys.